Welcome. Today we're covering how to evaluate growth stocks, revenue, TAM, and the Rule of 40. Let's get started. Evaluating growth stocks requires a different framework than traditional value investing. Many fast-growing companies aren't profitable yet, they're investing heavily in expansion. You can't use a P/E ratio when there are no earnings. Instead, growth investors focus on revenue growth rates, total addressable market, and whether the underlying business economics are sound. For growth companies, revenue growth rate is the most critical metric. A company growing revenue at 40% per year is doubling in size every 2 years. What you're looking for is consistency, not just one great quarter, but sustained strong growth over multiple years. When growth begins to decelerate significantly, valuation multiples typically compress sharply. Total addressable market defines the ceiling for a company's growth. A business with a $5 billion TAM can never become a $50 billion revenue company. Great growth stocks typically operate in massive, growing markets. When evaluating TAM, think critically. Management teams often present the largest possible interpretation. Look for credible evidence that the market is as large as claimed. The Rule of 40 is a widely used benchmark in software and tech growth investing. Add the company's annual revenue growth rate to its operating profit margin. If the result is 40 or higher, the business is considered healthy. A company can score well by growing extremely fast even at a loss, or by being moderately profitable with solid growth. The rule balances both dimensions. For companies with no earnings, the price-to-sales ratio is the primary valuation tool. A software company growing at 50% annually might command a PS of 15-20x. The same multiple on a company growing at 10% would be dangerously expensive. The PEG-style adjustment, dividing PS by the growth rate, helps normalize valuations across different growth rates and is a useful starting point for comparison.